Hi there, traders. This is Brad Gilbert with the Daily Market Insight for Thursday, the 5th of May. Right, now into the thick of the Asian session here. Now, obviously the big news, the Fed raised interest rates by 0.5%, right? A little bit of crazy price action around this because there was a bit of a twofold thing. They were expected to raise by 0.5%. We got that. But I think something's been a bit misconstrued here in the whole statement. And one of the key things that in the press conference was, let me just get my pen again. If you look at this part here, Jerome Powell was asked about whether they were actively considering 75 basis point moves in the future. And he said, absolutely not, right? They took that as being a less aggressive stance. But if you read through the general text, right, if I just actually get up a more recent story, he actually has come out and said in June and July, we may have similar rate hikes, right? If I just get the pen again, this part here, similar size rate hikes at upcoming meetings in June and July. So for some reason, I missed it, but the market was expecting potentially 75 basis point moves this time around and coming up, right? I never sort of really saw that picture. I just heard that they were going to raise interest rates aggressively, and 0.5% is. If they get another 0.5% in June, another 0.5% in July, well, to me, that's pretty aggressive. And as I was saying, this part here about was not actively considering a 75 basis point hike. That doesn't tell me that they're less worried about interest rates. They are still worried, and they have still laid out the path. So what is it? Anyway, so you got to think about what they've said, what the market was expecting, and now consider the reaction. Now, the equity markets have had a splendid day. It's almost like they haven't done anything. But don't forget, the 0.5% was factored in. Now, the market's taken the fact that Powell has come out and said they weren't considering 75 basis points as being less hawkish, right? That sort of puts the cat amongst the pigeons. I think this is a massive overreaction. Following the release of the interest rate decision, the statement, and then the press conference half an hour later, it just doesn't, it smells a bit funny to me, right? But now if we look at the markets, regardless of it smelling funny or not, we've got to look for opportunities here to get into the trade. Now, the big change here was apparently the so-called not so hawkish, but to me they are. But anyway, let's just go with the less hawkish stance. So what we've seen is a bit of a clean out on the dollar positions. We've seen some stops triggered, short euro positions triggered, gold's come back a bit, oil's gone up as well as the EU come out, and they're talking about they're not going to use Russian oil, etc. Limits where they can get their oil from. Basically, the price spikes there as well. But equity markets, here they are here. NASDAQ and S&P 500 had a really nice day. Is it real calm conditions for them? No way. They're, they have had a nice day on the market reaction. But as I said, I think it's an over exaggeration at this point. And you can see the cryptos, Bitcoin sort of following that move in the equities, and the commodities also liking what they heard there from the Fed. Now, the biggest moves were on the currencies, right? And the Aussie, and it was up a couple of percent. It had the bit of a double whammy, and I never expected this for a second. And I still don't think the Fed was less hawkish than they were predicted to be. But the fact is, the RBA raised interest rates and have got a hawkish tone. We'll have to raise interest rates in the future. Not like the Fed, who are saying we're going to have to make similar step moves, 0.5% moves each one. And the Aussies rallied very aggressively. Now, once again, if next month, the RBA could be raising by 0.25. The next month, the Fed could raise by 0.5 again, if the numbers are all as strong as they are at the moment. So what we're seeing is a retracement here, Aussie back to its sort of key resistance level up around close to 73, the figure. I think this has gone too far as well. Clean out on the top side in euro and sterling and in the Kiwi, as you'd expect, right? I'm sure there's a lot of traders out there in the banks like me scratching my head going, hang on, what are we missing here? This is still hawkish and very aggressive. It's, as I said, I think it's an overreaction. I'm a little bit stunned, to be honest. Now, so a little bit of a drop in the dollar, as in some, stale long positions are cleaned out, but by no stretch is this dollar uptrend out of play yet. And dollar Swiss still above the support trend line. Dollar yen, well, it's still going up. I mean, we are hitting a short-term support line here, but a little bit under pressure. And with oil starting to rally again, it's putting downward pressure on dollar CAD, right? So bit of an odd one there. So this is the real where the moves are, right? The currencies have been somewhat subdued volatility-wise for a couple of years. Now we're seeing all the central banks come online. This is where the action's going to be, right? You've got to really pay attention, but at the same time, use some experience and try and sort of decipher what's the market done? Is that move correct or not? And then try and anticipate the next move. Right now, I'm strongly convinced that this is an overreaction, but I can't sort of just rely on that, right? So I'm looking at some of these levels. You're coming back and looking at euro and sterling. I mean, as I said, I think these things come straight back off, but it's hard to get short sterling in the middle of nowhere, and same with euro at this point. Aussie and Kiwi are getting closer back to levels that we can trade. And instead of trading euro, if you're looking for, for me, I'm still looking to get long dollars. I think dollar Swiss is a buy back towards this support trend line, and the dollar index is too far away from my liking as well. Dollar yen, well, could be some cheap dollars under 128.50 at this point. All right, so I mean that's where we are. If I just get the my tech page up here, which has got all the the hourly, daily, weekly, monthly charts for all the various instruments. If I just get the dollar index up, this is what you need to be sort of doing at this point. So see all the noise here in the hourly chart, right? But look at the daily, the weekly, and the monthly. This thing is still in an uptrend, regardless of this immediate sort of drop in the dollar index. So I'm not sort of concerned about that. I'm sort of waiting to pick things off. Now, how could we do that? Well, okay, if we come back to the economic calendar, don't forget, we've got non-farm payrolls Friday. We've got the Canadian employment numbers Friday as well. There's a bunch of different things coming out. We've also got the Bank of England, who are expected to raise interest rates today in the UK. Now, you're going to be watching this as well. Now, all the central banks have said they're going to have to keep raising interest rates from here. So you've got to expect that. So try and get your head around what the forecast is for their statement. That's the key, right? The moves are generally interest rate moves are factored in. It's more around trying to assess, are they aggressive or not? Now, to me, all the central banks have been somewhat aggressive. The Fed is still the most aggressive in my opinion. So just keep an eye on this as you go through the European day. It's going to be obviously very important. Sterling crosses massively on the radar and could be whipping around all over the place. And then as we come into Friday, you got the non-farm payrolls. As I said, the Canadian employment numbers there as well. Dollar CAD will be as loose as a goose. But what we're looking for is this is where the market. So each Fed meeting is a reset, right? You get a reset of this is what we're doing and this is the direction we're going. Now, any new data from this point, which includes the non-farm payrolls on Friday, this is adding extra value to that next decision. So if these non-farm payrolls are strong, it's going to push them again into that aggressive stance, which is already in place, but may actually push them a bit further. So now it's really the inflation that they're trying to curtail. So, and it's going to take a few months for that to happen. So I can't see any sort of change in the dollar, but keep an eye on the non-farm payrolls Friday. Obviously, the Bank of England today and the Canadian employment numbers Friday as well. And it's, if anything, it's actually quite exciting that we are seeing the market, if anything, react, whether it's an overreaction or not. It is a good thing to see, and that gives us plenty of trading opportunities. So what have we got right now? So if I just have a look at the markets here at the moment, the US equity futures, well, they've hardly moved on the day, right? They're slightly down, but we are seeing a risk-off profile on that. Dollar CAD, the odd one out, and that's primarily, I think, because of the EU who have come out saying they're not going to use Russian oil to push the price of CAD up. I mean, oil up, that's given the Canadian or dollar CAD a lower move, but the dollar itself, it's starting to like this is baby steps. I know it's all those equity, US equity indices were up about 3%, but as I said, you usually find the result. Like this could be just once again, and you see this occasionally. It's like a market flush out all the stale positions. To me, there was stale euro shorts, stale sterling shorts. Aussie had already had a little bit of a move earlier in the week with the RBA, but this knocks out a lot of the week's stale Aussie shorts and stale Kiwi shorts. This is where you get a reset of a big move. If we get strong non-farm payrolls Friday, then I've got to start thinking about, what's the consequence of that? And that would be start to see a correction in all these moves if we don't see it already Thursday in the North American session. And the other part is as well, don't just consider strong numbers. If the non-farm payrolls for some reason were weak, well, now it adds a little bit more support to the whole idea that these things might go a little bit higher. Like the whole interest rate cycle for the Fed is nowhere near over, right? As they've said, expect similar rate hikes, 0.5 June, July. That's another. So all up, that'll be 1.5% move in 3 months. That's pretty aggressive, right? And this 0.5% move is the biggest in 20 years. So imagine another 4% coming up in the next 2 months. It's hectic. All right. But anyway, so that's the thing. It gets the discussion going. You have to try and work out from here what's what and what's not. As I was saying, if you come back to the main sort of data page here, the really nice day for the commodity markets. Okay, oil a big driver of that. You got a risk-off profile at the moment with the US equity futures. Suggest euro, sterling, Aussie, Kiwi go down, and the dollar pairs go up. They are. It isn't much of a move, but you'll see the real direction come from that North American market where the news emanated from, right? So as you can see, risk-off pairs, Aussie, Kiwi, CAD down. Well, actually, dollar CAD is down. It's not the CAD itself. Safe havens, well, no real alarm at this point. So the market seems pretty happy with what they've seen so far. And I reckon we're going to have some really good trading opportunities coming up. All right, guys, all the best. Cheerio.